The Mobile Workforce Podcast. Industry insights, construction perspective.
Hello and welcome back to the Mobile Workforce Podcast. I'm your host, Mike Merrill. Today we sit down and have another great conversation with Kathleen Baldwin, who is with CICPAC. On today's episode, Kathleen shares their Mobile Workforce Guide, which is a free to download guide on their website that will help you understand how to better track your per diem and expense reimbursements within your organization. This particular document was 54 pages of easy to read, geared towards and written for contractors, not the CPA. So highly encourage you to check this one out. It will give you a lot of great ideas and things that you should be asking for advice on and consulting with your CPA about to make sure not only that you're in compliance, but that you're also taking advantage of those resources and tools that they've shared with you to make sure you're doing things from a best practice tax perspective for your business. Check this one out. I think you'll really enjoy it. Hi, Kathleen. Welcome back again.
Thank you for having me again.
Awesome. Well, to start this episode, we wanted to learn more about and understand more about ASC-842. What can you tell us about that?
Okay. ASC-842 has to do with leases. In our last episode, we talked about mobile workforce and basically income tax items, tax-relatable items, deductible expenses. We're going to switch gears here and talk about the financial statements. That's where the leases really come into play. So ASC-42 completely revamped how organizations treat leases. So historically, you had a lease. The very first thing you determined, was this a capital lease or an operating lease?
Right.
All right. And if it was a capital lease, it was recorded on the balance sheet. And if it was an operating lease, it was not recorded on the balance sheet. You just had an expense every month. Yeah. And there was a note disclosure that let the users of your financial statements, your bankers, your sureties, any investors, things like that, let them know, okay, we are obligated for X amount of dollars in the next 5 years for operating leases. These are not reflected as a liability on the balance sheet. Right. So I kind of knew what additional cash outflow to expect from the organization. What ASC-42 said is like, wait a minute, the operating leases right now are being treated as, here's a term you've probably heard in the media over the years, is an off-balance sheet item.
Yes.
Okay.
Yeah.
The off-balance sheet items really came into play. Man, don't recall exactly how far back Enron goes, but 10, 15 years.
Interesting.
That was one of the major issues with their financial statements was they had all of these off-balance sheet items, meaning an investor is looking at the company's balance sheet and saying, oh, you have $100 million in debt, when really you've got $250 million in debt because you have these off-balance sheet items, whatever they may be. So as FASB was taking in all the various issues that were happening in the marketplace, they looked and said, okay, we need to look at leases, and operating leases are an off-balance sheet risk item. We need to bring those onto the balance sheet. So that's what they've done with 842 is now pretty much all your leases, except for short-term leases, are going to be on your balance sheet.
Okay. And look how well it turned out for Enron.
Yes.
I digress.
Yes.
So what impact does this have on daily operations in these companies, how they treat this?
The daily operations treatment is not really different. You're going to keep doing business the way you've always done business. Okay. Where it comes into play is going to be your financial reporting that you're doing either monthly, quarterly, or annually for your bankers, your sureties, and for your CPAs to prepare whether they do a compilation review or an audit. And where it could come into play for daily operations is going to depend on the organization. How many leases do y'all have? Do you lease your entire fleet of vehicles? Or do you just have company trucks? If you have a lot of leases, then it may be that you have a dedicated person, a staff person in the accounting department that does nothing but handle the leases, or should do nothing but manage the leases going forward. So that would be a day-to-day impact.
Okay. So how do contractors anticipate and treat those metrics as it pertains to the balance sheet and other things?
Okay, so that's a good question. And the lease standard, like I said, it brings the operating leases onto the balance sheet. So now what you have are financing leases or operating leases. And depending on the type of lease it is, and there's criteria that says, if it meets this criteria, it's classified as a financing lease. Okay. If it meets this criteria, it's treated as an operating lease. That determines where the information is put on the balance sheet. So when you have a lease and it's determined to be an operating lease, right. Now, financing leases the same way capital leases have always done. Right. So now you have to there's a new terminology used called right of use asset. So you have the right of use asset for the operating lease. That's an asset. And then you have down in the liability section, you have your operating lease liability. Where this impacts companies' metrics are that right of use asset is like a fixed asset. Okay. The liability is a liability, and you have a short-term portion and a long-term portion. Very important metric for contractors is working capital. Right. The bonding company looks at working capital, and that is a factor. It's not the only factor, but that is a factor in the bonding capacity for the organization. Well, I've added a fixed asset, the right of use asset, to my balance sheet. Okay, that's no impact on working capital because working capital is current assets divided by current liability. Current assets minus current liabilities. Okay. So no change to my first number of current assets. Right. But now I have this operating lease liability. I have a current portion and a long-term portion. So now I have a current portion. So there's an example in the guide here. Say I had $1 million in current assets, and pre-842, I had $600,000 in current liabilities. So I had working capital of $400,000. Yeah. Now, because my operating leases have been brought onto the balance sheet, and I have a current portion of that debt, my current portion may be $700,000. Okay. So my $1 million in current assets, now I have $700,000 in current liabilities. Now my working capital has dropped to $300,000. Yeah. And if the bonding company uses a multiplier of 10, saying I went from a $4 million bonding capacity to a $3 million bonding capacity. So boom, surface level, that's a potential issue. Mm-hmm. Second thing is my banks. So for my loans, I have debt covenants. So debt covenants, as you know, are certain requirements that financial statement required ratios to be met to be in compliance with the debt agreement. If I'm out of compliance with those debt agreements, then the bank can call the loan. Yeah. Okay. So you want to stay in compliance. Well, those debt covenants, part of those, some of those may be debt to equity ratios. Mm-hmm. Well, my debt to equity ratio, if I'm adding debt to the balance sheet for these operating leases that I historically have not had on the balance sheet, now my debt to equity ratio is going to be much higher. I'm going to have a lot more debt compared to my equity now than what I did, even though nothing has changed.
Yeah, it's the same. Same dollars.
It's the same cash out of pocket every year. I've got the same cash flow. Right. It's just, what are you calling it? How are you reflected on the balance sheet? Okay. So what this means is it puts the burden on the contractors. Yeah. Before year end, before the audit is done or the review financial statements are prepared, I need to talk to my surety and say, hey, once I implement 842, here's the impact on my balance sheet. Here's what my working capital is going to look like. Here's what my debt to equity is going to look like. Have that conversation with them so they're not surprised, because they may not, even though you were disclosing in your notes how much operating lease commitments you've had historically, pre-842. Right. Now it's a lot different when it's all on the face of the balance sheet, so bring it to their attention early. And as you know, that is the key with anything, any changes in your organization with the surety is let them know early on. They don't like surprises. Right. And the same thing with your bank. You've got a lot of great bankers out there who stay current on accounting changes. And so they know to expect my balance sheet. I'm not going to be able to use my old standard checklist and just plug in the numbers from the financial statements and boom, there's the answer. Right. Those that stay current in the industry know this is coming. And so they may modify that checklist, that formula. Yeah. But then again, you may have some bankers that do not stay current or haven't historically stayed current, and they get your financial statements and they go, oh, you're out of compliance. And it's like, wait a minute. Again, nothing changed in my company. You know, nothing has changed. Still same cash flows. But so you have those conversations earlier in the year to let them know what those changes are going to be.
Establishing a powerful payroll tech stack just got easier thanks to Payroll for Construction, the construction-specific payroll service that seamlessly pairs with leading accounting software like Foundation, Sage, QuickBooks, and more. As you run payroll, automatically update your job costing and general ledger with labor data. Then, Payroll for Construction takes care of the payroll processing. Sync Payroll for Construction with your accounting software today.
Makes sense. So are there recommendations for companies to consider when trying to decide, do I own and purchase or do I lease? Does that make sense?
Yeah. So, really, if you stay in conversations with your surety, stay in conversation with your bankers, and if you have investors, stay in conversations with them on how things have changed. The whole owning and lease, the idea of leasing in the past was, say you leased your fleet vehicles, with Enterprise Fleet Leasing Company, and the lease was structured so that, because there were certain criteria and there was a lot of, manipulation is a strong word, but there was a lot of finagling to write that. Massaging, yes. To write that lease agreement so that it stays as an operating, so it stays off the balance sheet. Well, now it doesn't matter. It's going to be on the balance sheet.
Right.
So the question is there an advantage to leasing or owning, pros and cons of each? And what I say is it comes down to, cash flow, the financial impact, because if you have a lease payment, and you've got that cash outflow, whatever that lease payment is every month. Maintenance is pretty much on the leasing company, all those maintenance items. If you own it, all of that maintenance comes in house. So you've got the expense. Who's going to manage it? Getting the service work done. Who's going to perform the work, et cetera. So you still have to do that, what I call the cost benefit analysis of leasing versus owning. But the factor that may have impacted that decision in the past, whether it was on the balance sheet or not, is kind of out of the equation.
Yeah. So when you do decide to lease, what about lease management and really overseeing that process for multiple pieces of equipment?
So this is where it may be that historically you've just used an Excel spreadsheet to track your leases. Or your accountant came in at the end of the year and built a schedule so that we could do that note disclosure for all of your operating leases. Right. It may be if you have a significant number of leases in your organization, whether you're leasing heavy equipment, you're leasing vehicles, you're leasing office equipment, you're leasing buildings, it may be that you say, okay, now we're going to utilize a lease tracking software. And there's some great products out there. There's Visual Lease, there's Lease Query, there's Lease Crunch. And these tools have been developed to basically manage your leases.
Okay.
And I've done a demo of the Lease Crunch product, and so I've seen it. And a great thing about that product is it will help you determine, it's not like you just enter into these fields, the specs of the lease. Right. It will guide you and help you understand what is the criteria for determining is it financing or operating. So it has some help features built into the program. And then the program will also spit out for you the journal entry that you need to record for the right of use asset, the liability, and the expense and the interest.
Okay. Well, that's nice.
Yeah.
It's really convenient, right?
Yeah, it is. I mean, it's not something you want to wait till you're closing up your books at year end. So in January, you're trying to build out your lease situation. If you manage it throughout the year, then that's going to help you in your closeout process. Yeah. And also it's going to allow you to not have surprises. Another thing with sureties is they don't like it if they get June financial statements from you that you look like you're in this type of a condition. And then 1231, all your year-end entries, all of a sudden it's like working capital has gone away. And they're like, and your net income has gone away. Sureties don't like that.
Switched midstream.
Yes. So, again, no surprises for the sureties. They want to know everything ahead of time. So if you're tracking your leases throughout the year, keeping your books updated throughout the year, then again, it, eliminates the surprises for the sureties at the end of the year.
Okay. What about when there are operational adjustments in between, or how does that get impacted with this?
You mean operational adjustments? So we decide to go from, our lease ended and leases all ended in July, and now we're going to go out and do major purchases.
Might change your tactic.
Okay. So what I'm going to say to you on that is, so we're talking right now, we're talking financial statement impact.
Right.
So, really, like I said, it's not going to impact your cash flow, so to speak. You're still spending the same amount, whether it's lease expense or whether it's, right of use asset expense plus interest expense.
Right.
So cash flow wise, it's not changing. Net income wise, your financials aren't changing. But tax return wise, now for tax purposes, there are rules, and again, they're subject to change, with tax code that may say if you purchase X amount of vehicles and equipment, fixed asset purchases in the last quarter of the year or through the first 3 quarters of the year, you can go ahead and write off the full amount this year or a portion of that amount this year. You can take it as a deduction this year versus taking 1/7 of that deduction going forward. So that if you're making a mid-year drastic change like that, you need to have the conversation with your CPA. And your CPA may say, okay, in July, let's go ahead and make these purchases now. Or they may say, okay,
hold off.
What's going to be best is, can you just purchase make half of the purchases now, and then February of next year, we make the other purchases so that we can split it into 2 tax years to maximize the amount we're able to deduct. So that's where that type of change, yes, it changes some on financial statement presentation, some disclosures, but that's when tax compliance and tax planning strategy comes into play.
Okay. Yeah, that makes perfect sense. So what about when they're audited or have compliance issues that they need to validate? Does this help with that process?
If you have a lease tracking software, then that does help your audit process. So one of the things the CPA looks at when they're auditing your books is the client does the client understand GAAP, generally accepted accounting principles, or not? Or because if I have to come in as a CPA at year end and I have to prepare the worksheet, do all these calculations for you to record the lease transactions, now am I independent of your organization to be able to audit you? Because I can't prepare the numbers, make the entries, and audit that same transaction. So from a compliance standpoint, the construction company, you may miss 1 or 2 in the scheme of things, but you need to have a good faith effort of understanding what are the accounting rules now, and do I have processes in place internally to identify leases, to determine if they're financing or operating, and to make the adjusting entries.
Okay. So what about future outlook and forecasting, and where does that come into play here?
So you mean as far as this ASC-842's impact on the future?
Right.
It really comes down to tracking. That's the impact is, tracking so that you can prepare correct financial statements. And it's the conversations with the sureties and the bankers. Knowing that pretty much every lease I enter into, unless it's a short-term lease, pretty much every lease I enter into is now going to impact my working capital ratio. So, the lease standard's been in place now, 2 years. It's been effective. So we're on the 2nd year now, I believe. And maybe I haven't had much lease activity. And so it wasn't an issue. But now, because we've changed in our organization, we're taking on different types of work. We now are going to utilize more leases in our company. And so my financial statements are changing from the standpoint of I haven't had a lot of leasing activity in the past. Now I do. So I need to, again, have that conversation on the forefront with my sureties to say, okay, here's a change you're going to see in our financial statements, and here's why, so that they're prepared for it.
Yeah, or if something needs to be adjusted, then they can make that recommendation versus you trying to figure it out later.
Right. It's easier just to shoot an email to them, pick up the phone and call them, than to say, okay, I'm going to make my best guess and get to the end, and then they're surprised.
Establishing a powerful payroll tech stack just got easier thanks to Payroll for Construction, the construction-specific payroll service that seamlessly pairs with leading accounting software like Foundation, Sage, QuickBooks, and more. As you run payroll, automatically update your job costing and general ledger with labor data. Then, Payroll for Construction takes care of the payroll processing. Sync Payroll for Construction with your accounting software today.
Love it. So is there anything on this topic that we haven't covered or that you wanted to really drive home for the listeners?
Yeah. So in here, in our guide, our leases implementing ASC-842, we have prepared for you a side-by-side comparison of your balance sheet pre-842, post-842.
Oh, nice.
And we've highlighted what's different so that you can see these are the line items, the proper terminology to use for these line items. For the balance sheet, for the income statement, again, pre and post implementation of 842. Nice. And then also we provided some examples on the impact on your debt to equity ratio, your debt coverage ratios, and we put in actual numbers for the various items so you could see the calculation and go, so you can have a visual.
Yeah. Right.
A lot of times you need a visual for something to really, for the light bulb to click in your head. Okay, I understand what they're saying. And then, related party leases was a major concern in the very beginning because, the contractor owns the building. He leases it to the company on a month-to-month basis.
Okay.
When this standard first came out, there was a lot of heartburn going, wait a minute. We've never put these month-to-month leases on the balance sheet. We haven't even included them always. We haven't included them in our 5-year operating lease schedule because they're month-to-month leases.
Right.
So they didn't, meet the definition not to be included. Now, they were communicated to the users of the financial statements in the related party note disclosure, where we talked about these are all the transactions that we do with related parties. Right. But that was it. And so there was a lot of concern of how am I going to calculate this right to use asset in this liability for these related party month-to-month leases. There's nothing in writing. There's not an official document.
Right.
So that caused a lot of heartburn for about 2 years. Wow. Worst case scenario, what are we going to do? At the nth hour of preparing financial statements, once the ASC-42 became effective, FASB came out and said, okay, we're going to treat related parties different. Okay, so we got to pass on, you can still have those month-to-month leases. You don't have to apply 842 to this. So I would say if you have related party leases, again, talk to your CPA, make sure you're handling those properly. Again, we give examples for various lease situations. And there's another item we haven't touched on. It's embedded leases.
Wow. Okay.
So you have a job site and you're going to lease a crane and an operator.
Okay.
Well, you have your agreement, you have your contract with the crane operator.
Right.
And you're treating it as a job cost, right?
Okay.
You have to evaluate now. You need to evaluate, is that an embedded lease? Do I need to put it on my balance sheet as a right of use asset and a liability? This is an issue, a topic that thankfully for financial statements, we have a concept called materiality. If something is in materiality, the dollar value is different for every company, and it changes every year. Depends on your activity during that year. But if the dollar value of this, what you determined, you said, okay, yes, it meets the criteria. This is an embedded lease. And before you go through all the hassle of doing the calculations and posting the entry to your account, to your balance sheet, you may determine the impact is $10,000.
Right.
To my financial statements, $10,000 is not material. Okay. So you just document it.
Right.
We've evaluated it. There is an embedded lease, but it's not material to our financial statement. Yeah. So you can ignore it, but you do need it. The auditors and the client needs to go through the process. And what that shows is that you have the skill set in-house.
Yeah.
You have the understanding of GAAP to know this could have been an issue. It's not this year,
Right.
but I do know to be on the lookout for it.
Yeah.
Yeah. So embedded leases are something that the contractors do not like. We don't want to put on they don't want to put on their balance sheet
Right.
the crane. That's not their crane to own.
Yeah.
So, or the mobile trailers at the job site, all of those things that are built into a subcontract, you don't want to have to evaluate that. You don't have the time to evaluate those. So embedded leases are covered in here, given some examples. And so that's some other good information that's included in this document here. Let's see if there was. Yeah. And then we give some links. In 2021, the AICPA came out with a set of sample financial statements with disclosures for contractors.
Okay.
So if any of your listeners are not sure, over the last several years, we've had significant changes with revenue recognition and with leases that have changed the terminology used for financial statements, and has also had our note disclosures grow from 5 pages to 10 pages.
Yeah.
There's a lot of verbiage now behind the financial statements. The AICPA put together a set of financial statements that gives you an example of here's some sample note disclosures, here's some sample presentations. So it's a good reference point for the contractors. We have a link in this document to where they can go out and see those sample financial statements.
Great. Well, very helpful, very informative, and you made a topic that might not seem very interesting, a little bit interesting.
Well, thank you for that.
Thank you for that.
Yeah. Sometimes it's tough to talk accounting. But, construction accounting is unique.
Sure.
They have, situations different from just a general retail type industry. And so for me, it makes it fun.
Yeah.
It's fun. It's interesting. And, but there's a lot of, quirkiness to construction financial statements that you really need to understand.
Yeah. This education is key for a lot of companies that they just don't know any better or different because you learn this stuff by going through it, and they don't always have the best resources at their fingertips, or they don't know where to find them.
Right.
So we appreciate you bringing this to the forefront and giving them a resource that can help them be better.
Yeah. Thank you.
Thank you. And we'll again, like I said, have to have you back and we'll talk tax down the road.
All right. Thank you.
Thanks.
Thank you for joining us for the Mobile Workforce Podcast by Foundation Software. To hear more episodes, visit us at workmax.com/Mobile Workforce Podcast, or subscribe to the Mobile Workforce Podcast on Spotify, Apple Podcasts, or your favorite podcast platform. And if you like the show, be sure to leave a 5-star review, share with your colleagues, and follow us on Instagram and TikTok at Mobile Workforce Podcast.